I certainly can, based upon my knowledge. I didn't do them. I mean, I can give. So these were EFRs or
They were EFRs.
EFRs. Yeah, I mean, I can give you my 2 cent analysis, but I did not do them, so I don't want to, assume anything as far as, if you've got any insight, you're more than welcome to interject too.
I mean, I don't know any. I don't know who did them either, but I
I mean,
think.
I can tell you what typically I think they are, but without doing them, I don't want to, speculate.
Well, it's essentially it's a swap. Someone
Yeah, no,
turned
no,
the futures
that's exactly what it is. It's a
turned the futures
swap
into a
where,
swap.
yeah, yeah, or there's an exchange for physical, obviously, exchange for financial, which is just a financial transaction, exchange for risk, which is typically a swap, and I'm not sure how. I can definitely get clarification and ask somebody that probably did them and get definitely report back next week exactly what it was.
Well, why don't let's I think we should discuss it. I mean, since it was there.
Yeah, no, definitely, definitely.
All right. How was your conference?
It was really good. We had, I think we had like 25, 26 people, so it was really good.
Really?
Yeah, yeah, it was a nice turnout, a good, you know, just mix of different people from all over the country. So it was good. It was just good to, kind of get a feel for what everybody's seeing. I think the collective, there's just a big backlog of existing business. The multifamily component is set up for significant organic growth. And at the pulling from the single family component, I think the single family, and I'll show some charts here on homes under construction, that kind of stuff. I think you just have this big backlog, but the real growth moving forward is going to continue to skew toward the pulling from single family.
Yeah, I heard on the radio this morning something really interesting. A rent to own concept where you
I've
find,
heard that. Yeah, I heard that. Yeah,
but this
yeah,
one, this one had a really interesting twist. You find a house that you want to buy, or that you like, that's for sale, not for rent.
yeah.
You bring this company in, and the company buys the house, and you rent it from them.
Yeah, and they charge a slight premium. They save that money for a down payment, and then at some point off in the future, you've been paying rent, but part of that goes toward the down payment. Is that kind of the same? That's what I've
Um,
heard on the radio here.
yeah, I'm going to look into it a little further, but I find it interesting because, like right now in Chicago, there's basically zero um, homes for rent. Like there's condos and stuff, but if you
Yeah,
wanted to
yeah,
rent a home, so this would be really interesting where you could come in and say, look, this is the home that I would like to buy. I can't buy it right now. Why don't you buy it for me and I'll rent it from you for the next 3 years? Um,
No, I think
and
I think it's a great deal because it's a great concept with the idea that somehow you can rent a house, but you can't buy a house based upon credit, based upon down payment, but you could afford a higher rent versus the actual cost of probably not so much now with the home price appreciation, but I always think it's comical that somehow somebody can pay their monthly rent, but to actually own a home, and you get these people that are just stuck in the rent cycle because of it.
it is, it is kind of funny. I mean, there's a lot of old school things in a lot of different businesses, but if you want to talk about an old school business, just actually buying a home and think about all the documents that you have to go through just to sign, um, like the title insurance.
Yeah, yeah.
You have to
No,
pay title insurance if you buy the home and then sell it to someone a minute later. You have to buy title
it,
insurance.
yeah, no, trust me, we're in the process of selling our original first house. When we moved, we kept it as a rental property. It was basically we saw it as a college fund, and we've kind of reached that point where it's time to take the money and run. My oldest son is a junior in high school. I've got another freshman in high school, so we're going through it firsthand. The the silliness of how this transactionally takes place and what's all involved. But no, they're just they're even like again, I can speak from this area, the Cleveland area. There aren't a lot of homes on the market, and anything that's livable, that's ready to go, you'll get at least ask, potentially command a premium, and you're certainly not seeing a slowdown of people looking for homes yet.
No, not yet. But I think the new paradigm of interest rates may change that. But anyway, all right. Welcome everyone. It is Tuesday, May 3rd today.
Yeah, May 3rd already.
And we are Lumber Futures from the Free Seats. Greg Kuda, Mike Wisniewski here. So let's just get this thing kicked off. Greg, I'll bring your
yeah,
page
glad
up.
to be back. Thanks for holding down the fort last week. And we'll let me get to the right screen. We're
It's a
ready to
little.
go.
I can tell you, doing the show is a little bit easier when you're here.
Yeah, you don't have to do all the talking. Yeah, trust me. That
I think I like being the color guy. If we were play-by-play or baseball announcers, you would be the play-by-play. I'd be the color guy.
I like that. I'd like to make the money that especially the football analysts make. But
Yeah,
I figure we'll start usual big picture and then funnel it down to lumber futures. So I'm not going to dwell too long on each of these charts. Obviously, Mike, if you see something you want to stop, then please chime in. But I think the one thing that jumps out, again, this is crude oil as the red line, S&P is black, Dow is green, NASDAQ is blue, lumber is orange, interest rates are purple. Well, I can't even condense this chart to reflect interest rates. So long story short, 10-year now, after this move back into 1.66, you're basically out to a new high water mark, just sub 3% now. And we'll see this in later charts, but I think the one big takeaway here, even with crude oil, with all these, you have lower lows and lower highs. And I think that seems to be the theme, and that we're getting some consolidation, but the pattern is playing out here with assets in general of just lower lows and lower highs. And I'm not going to, lump in inflationary stuff like agriculture or some of these other things, but just at least from a stock indices standpoint, a lumber standpoint, and even crude oil, we have that pattern of lower lows and lower highs.
the thing I'm looking at crude right here though is there's a bit of a coiling going on.
Yeah.
That we're making lower highs. It seems like there's kind of a bit of a bottom in there.
Well, and again, crude is very similar from a pattern standpoint. The backwardation, the inverted structure. When you look at the back month crude, so front month crude right now, June crude oil is 103, so still up over $100. You stair step down into DEES 22, you're at $93. You go out to DEES 23, you're at $81. So that just tells you, similar to lumber, that the further back to the back end of the curve you go, kind of points to where reality is. And when you look at the underlying fundamentals of crude, yeah, China has slowed down dramatically, but how much of that's been neutralized with what's going on in the Ukraine with Russia right now, to where we're still in an undersupplied market. When you look at the underlying fundamentals, you're undersupplied relative to demand, increasing demand coming out of COVID, to where until you bring more supply on, whether it's here or globally, you're still in an undersupplied crude market, to where for me anyway, technically the pattern, that inverted structure, says that you buy these dips in crude until you can prove that you're at equilibrium. And so far you're not at that equilibrium level where you're still undersupplied.
Yeah, no, we need demand destruction or more supply to come on.
Yeah, no, I think that's the how does the Fed ultimately slow the roll here? It's going to be through demand destruction, and ultimately, higher prices will lead to demand destruction, and magically that'll help create supply. It's just I don't think it's anytime soon. I think it's an evolving thing, and it still has a long way to play out here. I thought this was interesting. I saw this on LinkedIn. I think this was either Dr. Ed or Mohammed, the ex-head of PIMCO.
Muhammad Al Arian.
Yeah. I think this is Mohammed stuff. He puts out a lot of great stuff, but this just shows you year-to-date um, comparisons, and you can see year-to-date how everything, outside of oil, gold's up 4.5%, oil's up. The FTSE is hanging on to gains here, but everything else is down. And then I put lumber at the bottom. Year to date, July lumber futures are down 8.5%. So, again, this kind of supports that idea of lower lows, lower highs. And, are we there yet? Probably not. There's probably lower lows ahead of us in most of these markets. And so, like, how do we get to this point? I thought this was another great chart here. This shows you the red line is yield, treasury yield. The blue line is S&P PE. And you can just see here, go back to 2020, and, it doesn't take a genius to figure out free money equals a massive influx of capital flows into the equity markets. And as that red line leads us back to the downside, the free money's coming off the table. Well, look at PE ratio, liquid equity returns. It's pretty safe to assume that the rally that started in 2020, the pandemic rally, was fueled by free money here. And as this gets reined back in by the not Fred, but the Fed, it's a lot easier. It's a lot more difficult to make money in equities without the free money attached to it.
Yeah, less dollars chasing the same amount of equities.
So this was another one that jumped out, and this is from the Fed. Basically with you can kind of read this, but the rich got a lot richer. I mean, the top 1% saw their wealth grow around $12 trillion from basically the start of, pre-pandemic, and the bottom 50% only gained around 1.8 trillion. And then you look at this, the middle 20% of U.S. households by income saw their combined assets drop to the lowest share of the total national total going back to 3 decades. So, again, the big takeaway here is if you didn't own a home, if you didn't own real estate and you weren't invested in a 401k, you weren't invested in equities, you're getting left behind.
Well,
We
look,
keep
when you
repeating
pump
that.
money into the system and you put it into the hands of the people go out and spend it. And what do they spend it on? Goods and services. And the profits from those goods and services roll back to the companies that provided the goods and services.
Yeah,
So
absolutely.
it absolutely makes sense.
And so again, we'll run through rates here. Again, this is just, again, mind-boggling where we were in February to it being the beginning of May, where there was really no expectation of a rate hike. We kept hearing it's going to be Q3, Q4, to the point now where there's the expectation, and just so everybody's aware, FOMC starts today. The FOMC meeting, the Fed meeting starts today. They announce tomorrow. And I think you're going to be shocked if it's anything outside of a half a basis point. If it's a quarter, the market's going to be shocked. If it's 0.75%, the market's going to be shocked. So the market has built in a 50% or 50 basis point rate increase really this coming month in May, and then next month in June, to take you from a half a basis Fed funds rate up to, really you're going to be at 1.5 a month from now. By the middle of June, you'll be at 1.5%. And the reality is that's probably still a point to a 1.5 too low based upon where Fed fund futures are telling us right now.
It's still extremely accommodative from a historical.
Yeah, historically, there's still a lot of free money out there. So averaged, I thought this was interesting, average 30-year fixed, we're up above 5% and staying there. When you look at 30-year fixed versus a 5/1 ARM, and a 5/1 ARM is just a fixed rate for 5%, and then it becomes variable for whatever the remaining term is. So you would think that, if you can't afford, do people start looking at this variable rate for the first 5 years? But money's gotten a lot more expensive year over year. Historically speaking, it's still dirt cheap, but over the last year, where we were a year ago, it's definitely more expensive. Inflation. So here's a great chart that shows inflation in the US compared to the Eurozone, compared to Canada, compared to the UK. You can see we're kind of surging up, kind of on that 4% year over year. Euro area is dragging behind. I think given when this chart is up to, it's not inclusionary what's going on in the Ukraine. I think you're going to see this red line euro inflation spike dramatically well ahead of everybody else here. You're going to see
Absolutely.
inflation very painful in Europe. And if anybody's going to go into a recession, I think you have to look at Europe into the end of the year. Inflation expectations. You got to love a chart where a line goes off the chart. So obviously, this was not well thought out by the Fed or really anybody else, and that the transitory inflation has become on the precipice of stagflation with certain commodities. And here we are, where we hope that you get the normalization and that this 3-year ahead kind of stabilizes. I know Goldman Sachs kind of had their expectations, and these are from the Federal Reserve Bank of New York, but these charts are actually from Goldman Sachs. I know that their long-term forecast on inflation is somewhere around 3.5 to 4%. So you hope that you kind of peak out here and begin to see this red line trend back down for everybody's sake. And so inflation expectations by age. I thought 60 and over, 40 and over. This is kind of when you're in your sweet spot from a earnings potential. So this is probably the segment that can handle inflation the best. Under 40, over 60, especially this segment right here can least afford inflation, especially if you're on a fixed income. The reality is your fixed income, even adjusted for inflation, is not going to keep pace with inflation.
No, that's a tough one. There's no doubt.
So, I'll run through these, but surging prices. So gas, electricity, used cars, food at home, gas, electricity, food at home. These are all core type items that it doesn't matter who you are. You're going to consume these one way or the other. And you've got these dramatic year over year increases. And so this leads to, we'll start working our way into lumber and housing now. I thought this was really interesting in that this is softwood lumber as a component of PPI, Producer Price Index. And you can, the thing that jumps out here, since reaching its most recent trough in September of 2021, prices have almost doubled, rising 90%. So this is just the lumber component of PPI, which is just a monstrous number. And then when you kind of spill it into other things that go into building home, steel prices obviously up, ready mix concrete, gypsum, for gypsum board, drywall, and then here's your lumber prices. So you've got all these things adding dramatic cost to building a home, not just the lumber component, but all the other materials that go into home building. So then this leads to the next chart, which is just mind-boggling. So we always talk about housing starts, housing permits, homes under construction, homes completed. We're building more homes than when we peaked out in 2005, 2006, which is just an astronomical number, where homes under construction, puts actual housing starts. You're basically almost to 1.6 something. And we know that housing completions are dragging woefully behind in that 1.2, 1.3 something. So, you're going to have this massive backlog of business that still has to transact to get these homes under construction to being considered homes completed. So there's a big backlog of business, both single family and multifamily.
When I look at that chart, the one thing that I see that's really interesting is the pullbacks, the down moves are so strong. You look back at like 1975, what is it, early 80 or 1980, and then of course the 2007 timeframe.
Yeah, and that's the
Um,
one thing. Those gray bars, by the way, are recessions. So, that's the other thing that correlates with those big pullbacks. Well, you go into a recessionary period. So, again, are we heading into a recession? I'm not going to be smart enough to say that. You're probably, given everything and kind of the way that we're kind of pushing ahead here with everything slowing down or the potential to slow down, you're probably talking end of Q4, Q1 before you would be into that reflationary type, I'm sorry, recessionary type time frame. But I'm not that smart to forecast this out, whether we go into a recession or not. And this is, the other thing that jumped out: FHA backed homes. They have more stringent requirements. You're not gonna, if you get an FHA loan, and I see this with the individual that's buying our house, they're not allowed to bid over the asking price. They can go to the asking price. FHA's got to approve it. But the interesting thing with this chart is that the FHA component is becoming a much smaller component of new mortgages, new home sales, and that you're at a 15-year low. So this just goes to show housing affordability is taking out these lower tranches of home buyers, the first-time home buyer, the people that would like to own a home, but can they actually afford it? The answer is it's become a smaller and smaller component. And you are, in having the conference, the seminar we put on last week, Mike, you're definitely seeing you're seeing less and less signs of single family organic growth, and everything shifting to the multifamily, where, at some point, rates, cost of goods are going to take out these lower tranches of new home buyers, and it's going to at least shift them to either renting or the single family component of housing, living in a condo or a cluster community, something like that. So we'll get into the usual stuff now. So here's a weekly continuation chart. This is obviously reflective of May. Still, May, even though we're in spot month, is still your front month on the charts. And I think we've bottomed, but bottomed to do what? You're still in that 38% retracement. 50% would put you back in that 1100 to 1130 area. So, I think it's pretty safe to assume that we're in this sideways settling out period where, as much as we don't want to believe it, lumber doesn't necessarily have to move $200 to $300 in a given week, where we could get more into these sideways ranges of $20 to $60, $70 and just kind of float sideways in the grand scheme of things.
Well, and I mean, the thing I'd like to point out on this chart, though, this is futures price, which is Western SPF. It's not reflective of what happened in the Southern Yellow Pine market.
No.
Well, Southern Yellow Pine bounced. It bounced less, I would say. Well, it went down more and probably bounced less than spruce did.
Yeah, and I'll show you that in another chart. The other thing that jumps out at me, with Fraser being at 1080, I think Canfor is a 1090 ask. Obviously print was substantially higher. I can buy May right now at 1029.90. So you do have the ability. I can buy July right now at 912. I can buy September at 860. So you still have that inverted structure, that backwardation structure, like we talked in crude, exists in lumber. And if I wanted to buy, I mean, May right now, I can buy sub 1030 versus the Mills ask price of 1080 plus right now.
Yeah, you can't imagine anyone is going, you know what I'm going to do? I'm going to go out and build a huge inventory, 180-day inventory at these prices.
No, I think it's the past the hot potato approach, where I'll be more than happy if you own the prompt wood to pay a premium for it. As long as you have it, I can get what I want it. But this is the past the risk. You assume the risk for me, and then when I need the wood, I'll pay you for it. May daily, you can see on a daily, we're starting to stochastically RSI get toward the upper end. You're still in this upward trending channel. You're kind of running into the 44-day, 50-day, 100-day Bollinger Band high. So it's going to take some work to break out above this 1060 area. Obviously, it could do it on illiquidity as we lose contracts in May. And then when you flip this to July, To me, July is your perfect coil triangular formation here where you're going sideways. It's conceivable you could have a breakout one way or the other. If you were to break out to the upside, it would portend to move into this 950 to 990 area. If you were to break out to the downside, then you're looking somewhere in this 875. 50, 62% tracement would put you back into that let's call it an 875 to 850 area. But in the grand scheme of things, you're probably talking a 975 to 875. So this is a relatively tight range. This is this is a relatively, from what we've come out of, this is a pretty tight range for lumber. It's
Well, heck,
almost
we could see that in
a
one day of
boring range.
trading.
Yeah, yeah, exactly, exactly.
Now,
Oh, and
I
I forgot to put the slide in. So the new limits did take effect, Mike. New limits are $49, and if we hit 49, then we would expand out to $75. So 49 and 75.
okay, perfect. It would have been nice if they would have just picked 50 and 75,
Yeah,
but
well, yeah. Well,
so when I look at that chart, I think the downside, um, like you've got a pretty significant double bottom kind of there. If we go back and test that double bottom and it doesn't hold,
yeah.
then it can turn into free fall, and there really is no target down there.
No, no, and I think I mean, I'll come back to these, but here again, so here's May, here's July, here's everything else on these charts. So again, what kind of premium does July deserve relative to September and everything else? May, okay, May's cash. How long can the mills have kind of rebuilt their order files, but as much as I'm not a big proponent of using the back half of the curve to project pricing, at the very least, you can make the market's telling us that the back half of the curve suggests where this market ultimately belongs, cash included. So it's going to be interesting if we can keep getting disruptions, if the mills can maintain control to keep these lofty levels relative to the back months of futures here.
I have a very unscientific way of looking at the market, and that's flat markets don't stay flat very long for whatever reason. And this from September out, through next spring, you're a flat market. It's a $40 range. So I think something's going to happen there.
Yeah,
I'm
and
not going to predict which way, but I highly doubt that we stay flat in that $800 range.
I wouldn't take the bet against that. And that lumber, rarely does lumber like to sit still. So
right. And think about this. Here's two sides of the coin. If you're a mill and you go, wow, I can basically hedge a lot of my inventory at 850 FOB mill, that's not a bad return. Now, granted, recent times we've seen a lot higher price. It's not a bad return. On the flip side, if you are a developer and you're like, I see on the writing is on the wall, I could build and sell or rent all these multifamily units. And if I'm building off a cost of 850, fine. I can live with that. So I think we could go either direction from here. You could see
yeah,
the
no,
mill and hedge it up.
And I think the other big thing that I take away from this chart, and we kind of referenced this last week in our seminar, where's the risk? There's no risk for the mill selling cash today at these levels, let alone having to ultimately take these levels. These are still highly profitable levels for a sawmill. Where's the risk of ownership? There's a lot less risk down here. If this is wrong and we're going to 650, this is going to be a lot less wrong the further out you go in this curve versus owning cash at 1080 versus owning May at 1030 versus owning July. So from a risk to reward standpoint, how much reward is that 1080, 1090, $1,100 for the buy side? All the reward is skewed toward the mill's favor up here. And from a risk standpoint, well, if this is any type of indicator of where prices ultimately belong, there's a lot of risk up here for ownership. So this is that whole idea, understand your risk to reward. And you referenced it earlier, Mike, and that do I want to build out inventories up here? The answer is no. We're going to just in time it. We're going to kick the can down the road every 2 to 3 weeks, and then we'll reassess and we'll do what we have to do. But typically, when you get these big parabolic moves to the upside, not only is it a short covering rally, I think there's also indirectly, directly, there's a big inventory build associated with these big moves to the upside. And I just don't see, with the cost being where they're at, with this big inventory build, it just doesn't make a lot of sense.
It's telling you not to, straight up.
So here's your, the species comparison. The green line is your southern yellow pine. Blue line is futures, and then you stair step up into the other species, eastern and western SPF, hem fir, Doug fir. So you can see there's a pretty big disconnect now on 2x4s between, your high water mark species is Doug fir, and then you stair step down, look at the disconnect between Doug fir and southern yellow pine. I think this is a pretty good indicator of where EBITDA is, and that, highest cost of production is up here, lowest cost of production is down here. And from a species comparison, this makes a lot more sense with southern yellow pine leading the charge to the downside. And then EFPs. This is as of this morning, we're up to 157 May EFPs. My guess is we'll easily eclipse this 201 from March. If I'm a betting man, there's probably somewhere, I think we'll cap out in this 225 to 250 area from an EFP standpoint.
So that's surprised. Well, I guess if I'm long, right, you're going to want to take the wood at the lower futures price than you are.
Yeah, and I know you had asked this, like, what am I seeing out there from an EFP standpoint? There's the usual type suspects in the East that will EFP, Eastern Boston studs, 8s, 9s, the full spectrum of studs. In the West, you're getting a mixture, obviously heavier 2x4s. You can get into some 6-inch, you can get into 2x4 10s, a little bit more of the exotic type tallies. Mills seem to be a little bit more accommodating, especially the pre-negotiated EFPs. Hey, I need I need a 2x4 tally that's heavier in this item. I'm looking at MSR. I'm looking at Western studs, and you do get to see that. But I would say the bread and butter type items are still going to be 2x4 number 2. Somewhere close to that 8 to 16 tally from an EFP standpoint.
What kind of spread are the studs getting? Eastern studs, like 9 foot.
That's a good question. I'd have to look at print to kind of, without just throwing a number out there.
So basically, the mills are going right off of kind of.
Yeah, I mean, everybody's got their, I think one of the biggest misconceptions when it comes to EFPing is that there's some magic sauce involved in how you pick a strike price. Really, the strike price is irrelevant. It doesn't matter if you strike it $200 under print, or you strike it $200 over print. The reality is you're still going to negotiate like you traditionally would a cash car. You're going to negotiate the tally, the shipment date, the freight, and then you're going to figure out your adder or deductor. If I'm taking studs, I'm going to take Eastern Boston versus I'm going to have to relate it to Western SPF type pricing. What's my adder? Where's it going? And you're just going to kind of let it evolve from there. And then once you agree upon that, the strike price is just the strike price to offset the future side of the transaction. Your cash side of the transaction is going to reflect that on a gross standpoint, but the net's going to factor in your deductor, your adder, your for the tally, for the shipment, for the freight. So you're still going to negotiate like you would a normal cash load. And there you go. Kyle just said all spreads per item are negotiated up front, and that's completely accurate. So I think people, when they look at EFPs, there's really, it's more or less, do you have the so guys that typically would negotiate a Western SPF right now are people that don't necessarily get to buy certain mills in the open market. So, hey, look, so-and-so's willing to, I can get Can4 stock if I do an AFP versus getting a Can4 listing, being able to buy off their cash list. Or Talco's willing to do something with me. Those are your two primary mills in the market right now, Talco and Can4. They're going to do upwards of 85, 90, 95% of the EFPs.
Got it.
Wait, I think no, we covered that. So you get into basis, a week ago, May was $25 under, cash was $25 over. You're somewhere in that $45 area today. And again, last trade in May is 1023.80 with print being 1080. So there's a pretty sizable disconnect right now between mill ask price versus where you can buy May.
And, theoretically that should close up here.
Yeah, no, yeah, absolutely. And then July, hang on one second. Let me switch back. So July, a week ago, we were 126. July today is 160. And so, what I'm seeing in July is hoping it higher to sell July, hoping that there's a shrinking of that May-July spread, or that July somehow can muster up a rally to ultimately sell into. I think there's very minimal interest to buy July, a little bit on these pullbacks, but there's a lot more hoping July higher right now than hoping July lower.
I could see that for sure.
September 165 versus 225. So, again, going back to, we've kind of flatlined in these back months where you're having we've seen the stability in cash, we've seen the stability in the markets run higher, but this is reflective in that May-July spread where May has kind of appreciated greater relative to the back months to kind of narrow the gap between cash. And these back months, whatever love they were getting from a buy standpoint, it's kind of flatlined right now. And that's kind of evident with the spread. Here's your May-July spread. This is last week. Fast forward, or I'm sorry, that might have been 2 weeks ago. I don't know if I updated that last week or not, but so we kind of went from 45 over. We peaked out in this 145 over area. Today we're back into the 109 area. It's 109 last, down 770. So you could make the case that, okay, this spread's going to hang on in the $100 area. You could come fill this gap in the $90 area and then bleed back out. Or if you do break down and fill this gap, and I'm sorry, this gap is a 101, you could come back into this 80, 90, 80 area. I really don't have a strong opinion on this May-July spread now.
I have a strong opinion on it. Could go either way in a very short period of time. As
it could be, or it could also be sharply unchanged.
Exactly.
So,
as the liquidity dries up.
I mean, the one thing, with May, July, you're still running this hefty premium in May, basically $110 over. When you go out to these other spreads like July, September, Sep, Nov, they've stabilized from 2 weeks ago. We talked about them being in that 20 to 25 over area. Here's Sep, Nov. I have these backwards, but here's July, Sep. You bottomed in this really, it shows stuff. There was volume done in this 2025 area. We've kind of floated back up today where we got out to 57.40. Same thing in the Sep Nov. You bottomed in this 20 to 15 area. You've kind of floated back out, again, albeit on light volume, back in this 35 to 45 area. So, either these are the greatest buys in the world and they're going to go out to $100, or you're going to see this kind of more reflective of that inverted structure in futures going back to a carry structure where ultimately, again, going back to that risk to reward structure where there's a lot more risk in ownership of cash. There's a lot more risk of front month futures relative to those back month futures where, if you're going to return to that carry market, the normal historical structure, then ultimately July Sep goes back to 25 over to 25 under. Sep Nov goes back to even money to 25 under. So it's beauty's all in the eye of the beholder here. And again, these are either the greatest buys in the world, and you're going to see these spreads kind of mimic what May, July did, or you're going to go back to this carry structure, and the market's telling you that lower prices are ahead, where it's reflective in the spreads and it's reflective in that inverted structure where the back months are kind of will drag everything else down with it.
Let's take a look at the volume and open interest. Just to, I don't think there's much going on there.
No, so a week ago we were at 28.35. Today we're 26.65. So obviously the big difference here is the May liquidation continues to play out. 979 a week ago versus 593. Um, this is still a heavier number for. Let me pull out my book here.
Yeah, that does seem like a pretty big number
Yeah,
considering
so
what.
I like to keep track of number of days to expiration. Today, we have 9 days to expiration, including
Yeah.
today. So, it typically, if you just look at the past 5 years, anything over 50, 60 is considered a heavier number. So we're in that upper band of heavy. There's still quite a few Mays to liquidate here between now and expiration next week.
And then what about the commitment of traders? We got that one. There we go.
Yeah, so CFTC numbers. I guess this is a jump forward here. The big thing that jumps out to me is you're getting liquidation of managed money on both sides now. You're obviously on this long side, you've liquidated over 90% of these commodity fund longs. Uh, this is healthy in that you're obviously not equal, but you've got a relatively equal percent of commercial longs versus commercial shorts. You are, in the grand scheme of things, holding on to open interest, which is a positive thing. I guess the only thing that jumps out on this is the other reportables, the non-reportables. I know we talked about this a couple of weeks, but you're still net long here. So these are always the interesting numbers to watch. If there's a bigger flush ahead, then my guess is it would be led by this net long position with both the non-reportables and other reportables. For right now, commodity funds have crawled back under their rocks and don't want to play in our sandbox anymore.
Yeah, I think the thing that jumps out at me there is just how heavily concentrated it is in the producer merchant area. Um, Essentially, fast money, investor kind of money just isn't seeing opportunity right now in lumber.
No, and I think that's directly correlated to the headwinds of interest rates and home price appreciation, where this was an organic growth area a year ago. There are all the green shoots existed, and flip the page here year over year. I don't, and I think we talked about this 3 weeks ago with the different sectors of the S&P, and home building still dragging woefully behind. It's still in the bottom 10. So this isn't exactly a growth area given all the headwinds facing home building.
Is it me or is lumber getting boring?
Are you saying that our 15 minutes of fame is up?
It might be. All right.
Yeah,
Well, look,
yeah.
we've definitely covered a lot here. We got 40 minutes in. I think the biggest takeaway is there are headwinds. The
Yeah.
the Fed is doing its best to calm things down. We know that over time, lumber has proven itself to be the professor of economics in the overall economy.
Yeah.
So it wouldn't surprise me just to see a kind of a gradual just deterioration in prices, nothing significant, ahead of what could be a potential, recessionary
Yeah, I
overall
mean,
climate.
outside of some stuff that's geopolitically influenced with what's going on in the Ukraine and Russia, I think most of these markets, just have a feel of lower lows or lower highs, lower lows until you get to some kind of equilibrium or some kind of perception of this is an investment type level again. And as much as the mills want to convince everybody $1,000 is some great investment opportunity, I think the industry through this inverted price, got, pretty soon limits will be back at $10 and $15. Don't hold your breath.
Well, actually,
I
you know
don't.
what? I was going to mention that. So these limits are in place now till the end of October, right?
Yeah, yeah. Well, until the end of October, or until there's rumors that the Montreal Wood Convention is going to be used as the platform to roll out the new convention or the new contract. So that's kind of, I don't have any, I don't have any. I'm just that's kind of the latest rumor, is that the new changes are coming very soon. So but I can tell you that as much as the CME would like to do this, do that, as far as those limits are concerned, that's a mandate from the CFTC. I know that there's
Okay.
bitching and griping that we need to. The CFTC would never let them do that. You can't have
Um,
all these limit up, limit down days.
Speaking of the Montreal Wood Convention, we're going to be live from the Montreal Wood Convention floor at
Yeah,
the last
that's
week in May.
exciting.
That will be
Yeah, no,
very
that'll
good.
be pretty cool.
All right, well let's wrap it up. We'll see everybody next week. Hopefully, lumber does something fun for us to talk about between now and then. But by next Tuesday, May is going to be basically cash, and July is going to be everything we want to talk about. I'm thinking.
Yeah, yeah, I agree with that. So yeah, let's I guess it's dangerous, and let's hope for volatility, right?
Exactly. All right. If anyone wants the slides from today's show, of course, let us know and we'll get them out to you. And as always, we appreciate your support. I know Greg and his team appreciates the support, and we look forward to seeing you next week.
Yeah, thanks again, Mike. Glad to do this, and just again, information wins, education wins. So good stuff. Thanks.
100%.